the increase in rates is going to have a real impact on people and a potential real impact on people's disposable income, but it doesn't need to be as dire as what is being reported. A lot of that comes down to who's taking care of them and where they're getting their information and their advice.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
Welcome back, wherever you are, whatever you're doing. I appreciate you listening to the podcast, and I'm not going to make you wait for too long today to get into the thick of it. We're going to talk about the impending crisis, which is on our hands, which is coming up, which the news would have you believe will be the end of the real estate world in the better part of the next couple of years. We're going to talk about what many are calling the renewal crisis, the renewal wall. There's a few other words that we've heard about it, but it's been in the news for the better part of the last year, and it's made the rounds all over again with a recent OSFI report that just came out a couple of days or weeks ago, depending on when you're listening to this podcast. Now, before we get into this, I'm going to go into a juicy dive into what OSFI is saying. So what that actually means to you, whether you're in real estate or a borrower or investor. We're going to talk a little bit about what you can do if it's you coming up for renewal, or if you have a client who does. What could the potential impacts be? And I'm actually going to break down what a renewal and a refinance is and what your potential options might look like as well as part of this big picture. But before I do, I got to ask you really quickly, if you're digging the show, just make sure to hit that subscribe button. And if you haven't already checked me out on the other platforms, we've got YouTube. Look up my name, Alex McFadyen, or Flow Mortgage Co. Or you can find me on Instagram at The Mortgage Plug or at Flow Mortgage Co. If you're loving the show, please definitely send me a message and or rate the show. Be really appreciative, and I'd love for your rating. Thank you so much, guys. Let's get into the good stuff here. So right off the bat, OSFI, who we just mentioned a minute ago, is the Office of the Superintendent of Financial Institutions. This is like, we've mentioned OSFI so many times this year, it's crazy. They are basically suggesting that higher payments at the upcoming renewals, which are set to come down they're coming down all the time right now, but in 2025 and 2026 is going to be the biggest check-in, and when it comes to renewals, is going to have a potential impact when it comes to housing. And there's no doubt that it will have an impact, but the question is, how much of an impact will the supposed renewal wall have? Now, OSFI's Risk Outlook report, which came out, basically noted the following: 76% of mortgages outstanding will be renewing in the next 2.6 years, which is by the end of 2026. Now, that's not shocking or surprising. Part of the reasons behind that is because a lot of people who've been buying in the last year and a half are also taking 2-year and 3-year fixed rates. So you've got to remember that within that 2.6 years, you've got a whole whack little people that have taken on 3-year terms, I guess, more than half a year ago. So you got to remember that when you're looking at those percentages and those numbers. And for obvious reasons, anybody that took a 3-year fixed rate wouldn't see necessarily a negative impact, or any impact, if maybe a positive impact, when compared to someone who has a variable rate with a fixed rate payment from 2020 or 2021 at a rate of 1.2% to 1.5%. Now, they further state that 15% of outstanding mortgages are variable rates with fixed rate payments. So those are the ones that they're worried about or thinking about that could have a potential impact. Now, for a little backstory, there's 2 different types of variable rate mortgages, and a lot of people don't realize this. There's variable rate mortgages, typically called VERMs. We call them frozen payments, fixed payments. You can call them whatever you want. But what happens is when the Bank of Canada raises interest rates and prime goes up, essentially less money is contributed towards principal and more towards interest, because the payment can remain the same unless the borrower opts to increase or decrease their payments. The other option is called an ARM, an adjustable rate mortgage, which is where the payments themselves increase or decrease to make sure that you're still paying the same amount of principal off. Now, obviously, those people who took adjustable rate mortgage payments already felt the pain, and some of them locked in, others didn't. Nonetheless, most of those folks have already either kept their mortgage as is, or they've locked into a mortgage term. We're looking at the VRM clients here as the biggest potential for a challenge when it comes to renewal wall or window in 2025, 2026. They say that they're riskier because they expect that those people will have at least 25 to 50% payment increases. Now, for obvious reasons, if rates remained where they are right now, if prime remained at 7.2%, as it is with most banks right now, there's no doubt there will be a significant increase to payments for most people who had these types of mortgages in the past. But we cannot forget that the Bank of Canada also has the ability or the option to reduce its overall and overnight rate. And if they do that, then these percentages of payment increases will be much less and much less impactful than the 50% we could be seeing today. Now, I mean, I could get into the ins and outs of whether or not this is something that the Bank of Canada should be considering when it comes to whether or not they reduce interest rates, but I think that's implied. Looking at the most recent inflation data that's come out just in the past couple of weeks, which I'm sure many have, and looked at the CPI data, the inflation data itself, which we've talked about in a recent episode, it's down. And the big chunk of that inflation data is interest in housing. And so it's a pretty obvious consideration to say that one of the key ways to eliminate this from being a potential crisis is by reducing the Bank of Canada's overnight rate. And many are still projecting to see at least a 2% decrease over the 2 years. And I'm not sure if it's directly correlated to this renewals, but it could be a big chunk of why they're looking at that as their primary consideration. So let's go into a little bit more detail here, because again, this renewal quote unquote crisis has been reported for quite some time. And right now we're in the middle of 2024. Holy cow. And I've already seen the impact of renewals and higher interest rates on families. And we've already seen what the potential impact of higher payments and rates will be. And I've been seeing this for the better part of the last year, but more so in the last 6 months. And here's what I've noticed and what I've seen. First and foremost, aside from 2 or 3 clients, almost every other person, and for context purposes, we've had about 75 renewal applications this year, maybe more, but that's approximately where we're at the beginning of May. Out of those people, we've had 2 or 3 that probably were best off to sell or let go of their existing property situation. And it was predominantly related to other debts, not related to their mortgage, at which point they had to consider letting go of the property and moving on into a different type of property itself, or just downsizing, or just getting rid of the debt altogether. In any case, that's a very small percentage of people. And we do expect that that particular number itself could increase as time goes on, as there are more people out there considering, what is it going to look like for me in 2 or 3 years, and the cost of living has gone up. Yes, there's going to be more people out there that we're going to see, but I just, initially speaking from an anecdotal perspective firsthand, I just haven't seen that many people have that serious of an issue. But I can tell you this secondhand, and I'll get more into what people can do later in this episode. I can tell you this, that if it weren't for many conversations with maybe 25% of the remaining people, they might be in a tougher position right now, and they would definitely be paying more money regardless as to what they decided to do. So we can say a few things here. First and foremost, the increase in rates is going to have a real impact on people and a potential real impact on people's disposable income, but it doesn't need to be as dire as what is being reported. A lot of that comes down to, realistically, who's taking care of them and where they're getting their information and their advice. So looking at the numbers here, just kind of breaking down what the potential impacts are, there is one point to be said. Now, if you don't already know, there's different types of mortgage lenders that are out there. There's banks, mortgage finance companies, credit unions, and there's also alternative and private lenders. I believe those that are going to and have already been hit the most early in the process when it comes to higher rates are actually those who are in alternative mortgage lenders. And many of those chose to go with 1 years and 2 year terms where interest rates have increased dramatically. And those are the places where we've actually seen the highest impact. Sadly enough, many of those people took those with the intentions on 1 year or 2 years later, refinancing or restructuring into a more conventional product. And in almost every situation, the people who did this was because they were a business owner or they were self-employed looking to get into the marketplace, and then they wanted to refinance at the end of their term. Now, the reason that we go to these lenders is because they're more flexible with using income from a business, or maybe it was low credit or unique sources. And these are hardworking individuals that just quite simply wanted to restructure and get into a conventional mortgage after the fact. Now, they've seen a huge increase or a swing so far from what I've seen, going from rates at 2.8 to 3.5%, all the way up to, in some cases, high sixes and high sevens. So what's happened, or what I've seen there, is that obviously that's caused people to see the impact really quickly, really early. Like they don't have until 2025 or 2026 to see those payments. And so we've seen that now in most situations, these people have been able to keep their existing mortgages. They've kept their homes. I haven't seen anybody that's had to sell yet, but it definitely made them consider their costs and expenses and what they're doing when they're considering all their potential options. So, what I find most interesting about all of this is that the primary people that the reports are suggesting is impacted are those with the variable fixed payment mortgages. And definitely, we placed a lot of clients into those types of mortgages. I mean, back in 2021, it looked like the highest potential upside for prime. And this isn't from me, this is coming from all of the economists that are out there. If you go back in 2021, the highest upside was 3.5 to 4.5% on prime. And obviously, we know what happened. It went up and up and up and up and up. And so, we dealt with last year, 2023, the trigger rate crisis, which was people being concerned about their property, not, or their mortgage payments, and being unable to make their existing mortgage payments or even make their principal on them because they were paying essentially all interest. Now, what's interesting is that now I think most people are past the trigger rate crisis and they know exactly what their options are and what they can do. And so what we've seen from here is that, okay, now people have made decisions. Now they've either chosen to do one of a few things. Number one, they've chosen to increase their monthly payment to make sure that they're paying off at least the principal on their mortgage, or at least the interest, I should say. Number two, they've chosen to pay whatever the payment would have been, so principal and interest payment. The number three option they've considered is to lock in. So they've considered to lock in with whatever that lender has offered them. And the fourth option is they've refinanced or restructured their mortgage in some other way. And so I feel like there's a large group of Canadians, at least that I've spoken to, that have considered a variety of different options. The sad part, however, is that the vast majority of Canadians who have taken these mortgage products didn't work with a mortgage broker, and they definitely didn't work with one. Many of them didn't work with one who actually looks at their situations post funding or tries to help them post funding. And so I do believe it's true that a large percentage of Canadians, anybody who worked with a bank, probably hasn't got anything other than a phone call to say that you're at your trigger rate, and they didn't really have a plan of action or any idea as to what they needed to do or what they could do. And therein lies my biggest question mark or concern, is that those people who have been uneducated about their options, even if you can say or should say or would say that they should be looking into it, regardless as to that, this is a pretty significant impact for a lot of Canadians. Now, for all of these things that we talked about that could be potential concerns, there's definitely some offsetting factors that we should consider about when we consider this impending crisis. But before I get into it, I think I want to touch really quickly on a few key points, because there's a lot of confusion about what's a renewal and what's a refinance and what are my options. In short, when you have a mortgage, you typically take a term 1, 2, 3, 4, 5, 7 or 10 years, and 10 years is in the news right now for other reasons. And at the end of that term, or close to the end of the term, you have the ability to leave the lender. So that's called switching, or you can refinance, but you can leave that lender as a free agent, so to speak, if you want to think hockey terms, or you can renew with that existing lender. Now, the vast majority of Canadians, they receive a letter via an email, an online portal, or something like that, and they just choose to either take a meeting with their bank or nothing at all and sign the papers. And that's the number one mistake that people make when it comes to their mortgage, because it's easy. The banks make it really easy to do that. However, I would suggest, with all the news and with all the information out there when it comes to rates and so much media like what we're doing right here, more people than ever are actually starting to consider looking at different options and aren't scared to talk to a broker who's actually trying to help them. And so the difference at the renewal time of what you can do is a renewal or a switch is when you're taking your existing mortgage and you're moving it over to another lender. Now, depending on how your original mortgage was structured, that could be a switch, in which case typically the other lender takes care of their cost, or depending on where you're located in the country and what you see, the second option is a refinance. And a refinance means some type of restructuring of your mortgage. And this is the most common thing that I am seeing right now is a refinance. The reason for that is because a refinance allows you to extend your amortization, which means to extend the timeline on the loan, maybe to 30 years or 25 years or whatever you need to. It also allows you to consolidate debt, set up a home equity line of credit, or make a variety of other changes in the structure of your existing mortgage. And because of the refinance capability, I'm seeing people actually being able to not be so negatively affected. Sometimes we're including a car loan, sometimes we're including a HELOC debt or a line of credit debt or something else. And so the vast majority I'm seeing of people who decide to refinance actually reduce their overall expenses and help improve their cash flow situation. Now, we have had some people that have opted to stick with the existing renewal and leave things as they are right now, but I would say that's definitely more rare. The biggest confusion around renewals and the biggest mistake that see people make, besides not talking to anyone, is they get too focused on what that rate's going to be. If you're looking to refinance or re-extend your amortization, of course you're going to pay a higher interest rate because you're restructuring the loan itself, and the lender that you're moving to isn't able to take on the loan at the same cost as what you've already previously done with your existing bank. And so the key here is refinances are a little different cost than a renewal, but there's a reason for it. And just like any tool, there's a cost associated with that particular program and going ahead with that. Now that I'm back off that little bit of a rant in terms of what is renewals, I hope that was helpful. Let's talk a little bit about what people are saying they're going to do and some different risk mitigants, some things that could impact these potential massive waterfalls of renewals or walls of renewals. One of the big things to jump into right off the bat is that there's this belief out there in the YouTube community, and I don't know, in the general public, that with renewal offers coming so high, there's going to be a significant amount of people who are going to sell off their properties like a fire sale, or I don't know, foreclose on their properties. And my general feedback or response to that is, with real estate values being such as they are right now, why would anyone go into foreclosure when they could get a second mortgage or private mortgage or just sell their property, and if they had to, take a loss? It really doesn't make any sense for anyone to foreclose right now. And I don't suppose or imagine that we are going to see anywhere near the amount of people who they suggest are going to foreclose when compared to the reality of what's actually going to happen right there. The second thing is, even if rates weren't to decline dramatically, the chances are that we'll probably only see an average payment shock of about 20%, which would be considered manageable. So, for example, a 20% increase on $100 is $120, on $1,000 is $1,200, and so on and so forth. But that would be what I would consider to be the high end, especially if the Bank of Canada were to lower interest rates over the course of the next 2 years. Another factor to consider is that fixed rates are already 2% lower than variable rates in some cases 1%. Most people were stress tested between 4.79 to 5.25% and higher. And if you can get a fixed rate around 5.25%, then technically speaking, people can still qualify even with the higher payments as they should have been. And that was the whole point of the stress test to start off with. So definitely needs to be some consideration paid to those facts before just spewing out that we're going to have these massive increases and people aren't going to have any options. So there are some key considerations when we're looking at our options. But that being said, it is continuing to be reported, and we need to look at the numbers to see what's going on. First and foremost, there is the quote unquote recession watch. I'm going off track here a little bit, but depending on who you talk to and where you look, there is still reporting and there are still suggestions that we will see a potential recession. Now, a couple thoughts on that right off the bat. I was reading a report from Deloitte just the other day, and Deloitte seems to suggest that we are going to see what's likely to be a soft landing. This is a report from April 2024. You can find it online and download it yourself. They also propose that we'd likely see 0.75% of interest rate reductions from the Bank of Canada still in 2024, despite a lot of people suggesting that's not going to happen because the United States is still way too strong. I think, if for no other reason than what we're talking about right now with the renewal quote unquote crisis coming down and with all the potential pain that's expected, there is a high belief that the BOC will be very conscious of that in their consideration and their decisions looking into the end of this year and into next year, because their goal, just like we talked about right there, is to provide a essentially a soft landing. That is the goal. And the way things are going right now, although it may enter a recession, it looks like that is a possibility. It looks like a real possibility right now. So definitely something worth considering when we look at the options that might present themselves. Now let's put things into dollars and cents right now. Based on where rates were at in the fall, like fixed rates back in the fall were at like 6.44% for a 3-year fixed rate. And if we were to take someone who took, let's say, a fixed rate and they were at 1.69, which was crazy enough an option back in 2021 for some time, and they were to go to 6.44% today, with the average Canadian mortgage or average Canadian mortgage balance, starting balance based on Q1 of 2021 being $300,000. Now, I understand that's less in a lot of cities and more in other cities, but whatever. We're going to stick with whatever the average was in Q1 2021. Using a 1.69, bumping up to 6.44%, there is, of course, a significant increase of 55%. In terms of dollars, it's a $678 increase in their monthly payments. But to put that in context, and I know this doesn't feel anything, it just doesn't feel better for most people to hear this, but whatever. To put it in context, it's only $195 more than this borrower would have been stress tested for. And so when we consider the fact that most borrowers have made more money and or have earned a higher income, even when factoring in about a 15% increase in the cost of living, there is some truth to the fact that the stress test may have worked. Now, notwithstanding the fact that rates have come down by over 1% at that time, and this borrower may have the option, depending on how much equity they have, to refinance their existing mortgage back to 30 years, that number completely changes back to about a 20% change or a 20% increase, therefore eliminating that extra $195 and putting them in a more likely position to be able to pay off their mortgage and keep their loan as is. So, what are some real options that people have that I've seen many consumers consider? Obviously, number one would be, I've mentioned it multiple times, taking your mortgage that might have 25 years remaining and moving it back to 30 years is a quick and easy win. And I think the biggest consideration that I've noticed is there's like a psychological impact of people saying, well, I don't want to pay my mortgage for 30 years. Well, remember this, if you're taking your mortgage and you're throwing it down the road for 30 years, the truth of the matter is there's disinflation to consider there too. Your mortgage money that you're borrowing today at 500 grand is worth a hell of a lot less in 10 years or 15 years than it is today. And I know that doesn't defeat the fact that you have to pay interest on it, but the fact still remains. Someone who took out in 1995, someone who took out a $150,000 mortgage, yeah, they might be paying that back today, at least for another one more year, depending on how long of an amortization schedule they took. But even in that scenario, the amount of money remaining, that $10,000 back in 1995 was worth a hell of a lot more than it is today. In fact, 3 times as much. So if you think about the context of money, that doesn't feel as bad. The second thing is you can do what you want with your cash flow. So if you reduce your amortization schedule to 30 years, you can save up your money, you can invest it, you can do a variety of other things, you can qualify for more. I mean, there's a lot of things that you can do, and it could be a temporary thing. Maybe rates go down by 2% in the next couple of years, and you can increase your monthly payments to match what you're paying right now. So that's one thing I'm seeing. The second big one is just looking at people's financial plans. So just telling people, get a clear track on what you are doing right now, financially speaking. So many people don't have a plan and they don't have a budget and they have no idea what they can qualify for. And yes, I understand that housing is expensive. And yes, I understand that there's cost of living has gone up. But the truth of the matter is if you have no plan, then you don't know what you're doing. And if you don't audit your expenses, you don't audit your situation, then how on earth are you going to be able to determine whether or not this is going to cost you a certain percentage more money? Maybe it will be impactful and it definitely will. But the truth of the matter is you don't know all the other things. I mean, the funny thing about it is I find that people will worry more about a $50 difference in their mortgage payment on a rate, let's say 10 points or 15 points, even if it's a better product for them, they will worry more about that than the fact that they drop, anywhere between 250 to 350 a month on takeout food or something of that nature. And that's not to say to minimize the value of food. I'm just saying, just generally speaking, people will drop, $30 for 3 beers, but they'll be worried about, other things that are probably less consequential. So point is, audit your own personal budget. There's probably a whole bunch of shit in there that you can get rid of. And I'm not talking about Disney Plus here. I'm talking about the big stuff that happens all the time. Other quick little thoughts that I don't think many people are thinking of is the fact that, and I brought this up before, is increased wages. Like, again, it's crazy because obviously I see people's incomes all day, every single day. And the truth of the matter is people are making more money. They are making more money, significantly more money in some situations. Like, there are certain jobs that I'm seeing that I would have thought, 4 or 5 years ago, I could have sworn, I could probably go back and find out pretty quickly here, that this was like a $50,000, $55,000 salary job. And now I'm seeing certain people in these positions making $75,000 to $80,000. And that's a significant increase in a short amount of time. And now I understand the taxes and other costs have gone up. But I mean, if you're increasing your income from 50 to 75, but you're not increasing your mortgage, you should be able to make up the difference in that cost at minimum, I would like to think. And again, that's another reason I believe that most people can make these payments. Nobody wants to. Nobody wants to. Nobody wants to give up the lifestyle. Nobody wants to give up where things are at. But you've got a few options. Number one, you can go make more money. You can work a second job, or you can find a way to get rid of some of your expenses. And the truth of the matter is, maybe you should do more than one of those things. But I mean, I think most Canadians could improve their situation by just generally speaking, taking a little bit of time to understand their mortgage options. Now, to leave things off here, just a few thoughts, again, back to what you need to do at Renewal. Vast majority of Canadians, I mean, I get messages all day, every day, like, hey, Alex, can you help me? I'm going to my bank to negotiate. Well, remember this, your independent mortgage broker does advising and brokers for a living. So if you send me your renewal statement and you answer some questions, I can tell you right away whether or not you're in a good situation or if it's a good option for you. But I'm going to ask you significantly better and more questions to help you determine what that is. And if you're happy with the options, 9 times out of 10, I can offer you something better. Then we work for you. We work with you as your broker. The bank that we send your mortgage to will actually pay us, and we'll restructure the mortgage for you. That way, you have your mortgage under management, which means you don't just hear from your bank every 5 years or when it's time to lock in. You hear from us when there's an opportunity in the marketplace with our proprietary programs. We actually can see when it makes sense to save money in someone's situation. Anyways, in summary, do we think there's a debt crisis coming? No. But do we think there is a reality of potential impact of variable rates and fixed payments and this renewal wall coming up? Yup. And I think a lot of people will be completely unprepared, and I think it will definitely have an impact on the overall marketplace. I don't think we'll see a great sell-off, but certainly there will be some people that will have to move. And the biggest mistake that is going to happen is that most people will not take the time that they have right now to prepare. They're going to wait and wait and wait and wait. And you should not wait. If you found value from this podcast episode, to share this out with somebody else that you found it helpful, send me a message and leave me a great rating or hit that like button. Thank y'all, and we'll see you on the next one.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.